Steve, we now know what the big beautiful bill entails. One of the big things was that concern that we were approaching a tax cliff or a tax increase. How big of a problem would you say the average American avoided?
Yeah, hi Rick. Thanks for having me on to talk about this. It's a big complex bill, but you touched on probably is what's the most important thing about this: the extension of the Tax Cuts and Jobs Act, which is what at its base the big beautiful bill did to begin with was that it kept tax rates from going back to where they were, which would have been a material increase in taxes across all of the income levels. And I do think it's important to note that there's broad bipartisan support for the vast majority of this extension. Even as we went through the presidential election, the Democratic platform was to extend something like 85% of the Tax Cuts and Jobs Act. So there was broad bipartisan support to extend the majority of this. Details around some of the things that were added, how it was paid for, where that may have come from, what some of the additional tax cuts. That's where some of the differences would have been. But man, at its base, this did avoid a big tax increase, which would have been a headwind to growth. That's just how you have to look at that. It's kind of how we think about tariffs. They're just a form of taxation. That's a headwind to growth. And man, if we'd have thrown an increase in income taxes on top of that, that would have been a real headwind for the economy to overcome going forward.
Well, speaking of growth, I need your help with this because I've heard, yes,
Mhm.
it temporarily adds to the deficit, but we can grow our way out of the deficit. How do you grow your way out of a deficit?
Well, you're right, Rick, and this does increase the deficit early. It decreases it back end. The way most of these bills work, it's measured over a 10-year period of time, and that's true for anything. And that's not unusual to see a bill to be kind of front end loaded, so you get that benefit, and then you got to pay for it on the back end because things can change over the years, and maybe they make some changes. But the key aspect of the proponents of how this would happen is that it's how you're spending the money or what you're using the borrowed funds to do that can lead to further growth. So just as an example, I mean, there's lots of sweeteners that President Trump added for individuals, and we can talk about that. But probably the biggest area that has the potential to impact overall economic growth going forward are the things that we're going to do on the business side of things. So the expensing of research and development, the expensing of building factories. This is the type of investment. And so maybe the way you could think about this, Rick, is we're borrowing to invest as opposed to borrowing to spend. When you invest, you expect a return, and there's an idea that that return will pay off more than what you borrowed. If you're using credit cards to buy groceries, that's not really a good way to use debt. That doesn't necessarily, but if you're using debt to buy a house, for individuals, that's maybe a better kind of debt. So that's what the proponents are going to say, Rick. There are question marks when we're making assessments about what this is going to do to the economy. The Congressional Budget Office did estimate that this could increase GDP by about 1.5% going forward. Whether that's enough to repay for all of the debt that you put on, there's a number of moving parts that go into that. But this does focus some of the big tax savings for companies to do things that could lead to future growth. Again, research and development, building factories, and thinking about tying that in to tariff policy, which is trying to get companies to move production back to the United States. This is one way to do that. Throw a tax sweetener out there, shorten that depreciation time. It really makes it a lot more financially feasible decision for companies when you do that kind of stuff.
Did I read this right on the no tax on tips and the no tax on overtime? This is a tax deduction at tax time. This
Yeah.
isn't immediate, I'm going to feel it in my paycheck tomorrow.
Not tomorrow. You're right. You'll get it as you file your taxes. Now it is for this tax year, so you will see that. And so on the tips, you deduct the first $25,000 of tip income. Now these have income limitations, and this is where, man, that's complex, and everybody's situation is a little different. So I want to be a little careful people need to make sure that they check with on their own individual tax situation. But yes, taxes on tips, if you deduct 25,000, first 25,000 up to $150,000 income level. The same thing on overtime, not the same amount. I want to say it's $12,000 on overtime. The senior tax, that is a $6,000 deduction on Social Security benefits for those that are getting that. So you're correct. It's not like a one-for-one type of a deduction. And importantly, those three, along with the ability to deduct up to $10,000 in interest expense to buy a U.S. made vehicle, those are all temporary. So, Rick, that's the other reason that this has a little bigger cost in the early years versus the later years, is some of these things are temporary in nature and then go away in 2029 and 2030. So it's a temporary benefit. And look, that will help people. I don't want to, you don't want to mitigate the importance of what that may mean, but it's not like that's a dollar for dollar deduction in tax expense.
You kind of touched on it earlier, but I did notice, and I'm sure you've seen the projections as well, that tariff revenue is already starting to flow into the federal government.
Correct.
Is that going to help pay for some of these deficit concerns? And I assume those are early numbers. We're going to get more as these trade deals get finalized. Is that right?
It is. And there's a couple of things going on here. This does highlight how this administration views tariff revenue differently than we viewed it in the past. It's not the most, I would say economists wouldn't say this is the most efficient way to raise revenue, but this is what the administration is doing. And yes, we have been collecting tariff revenue. And this is an important part. You may read, there's all different kinds of ways to try and estimate what the cost of this bill is, how much it might increase the deficit over the next 10 years. And one of the big variables is how much credit are you going to give for tariff revenue that we're bringing in? Some measures that are based upon the early revenue from tariffs, it almost sterilizes the cost. In other words, there's not a cost to this over the next 10 years. But what this is going to do, and since the passage of this bill, Rick, you've seen President Trump get a little more active now with tariff conversations. We made a deal with Vietnam. Here's the important part of that. With Vietnam, the tariff on imports from Vietnam is 20%. It was 10%. Going forward, what we think we're going to see is that 10% is going to be the floor, but the chances are that the amount of tariff revenue that we're going to be charging might be higher than what we're anticipating currently. That could actually help reduce the cost of this bill a little bit more, understanding that there's still an economic price to be paid as that tariff revenue goes up that risks somewhat higher costs for consumers. There are economic implications to what that may mean, but tariff revenue, yes, this administration is considering that part of governmental revenue as we think about what we're trying to accomplish.
And I know it's not all happy sunshine and rainbows. There were cuts to SNAP and Medicaid.
Yeah.
Are you concerned about what happens to the working poor and what happens to some of these people who we can't afford to keep them on the government roll anymore?
Yeah, no, look, I think there's a couple of things here. And yes, we are concerned about this. I serve on a charitable board here in Tulsa. Medicaid's an important part of how we deliver our services to our clients. It's something we're going to have to try and operate, see what that actual impact is going to be. I think the bigger part of this, Rick, is it just showed that cutting spending is hard. It doesn't matter where you're going to cut spending. It's going to be hard to do it. What with SNAP, basically what they did is they said, we're going to put this back on the states. We're going to ask the states to do more than what the federal government has been doing. With Medicaid, these were shifts around work requirements. They're going to now require people to re-up for Medicaid or re-establish their Medicaid eligibility every 6 months instead of once a year. So there's some additional things that we're asking people to do, to the degree that the federal government thinks they will save money by doing this. That does mean they're anticipating that there are some people currently getting Medicaid benefits that will not get them going forward. That's always a lot. That could be a tough pill to swallow. It will just be interesting to see how how that actual implementation, the numbers are going to come down to how people respond to that. As it's laid out in the bill, they're asking for able-bodied, with plenty of exceptions, but able-bodied people to work 20 hours a week. It's a part-time job to maintain that Medicaid eligibility. Absent their willingness to do that, that does mean that there are some that are getting benefits that will not be getting that going forward.
I know a part of this bill was increasing the debt ceiling, and I know
Yes.
you've seen the financial policy for years. They increased the debt ceiling. There's really no intention to pay off that debt. Are you suspicious of this debt ceiling increase, or does this one feel different?
Well, I don't know that I would say I'm suspicious of it, but the fact is, we're doing is, I mean, if we hadn't done that, we've made some commitments to spend money that we would not have been able to fund. And here's what I can say: I'm pretty confident in saying this, Rick. They increased the debt ceiling by $5 trillion. That means we are going to borrow $5 trillion more dollars at some point. We're going to hit that debt ceiling again, I would suspect, at some point in the future. However you want to look at the impact of one big beautiful bill on our fiscal position, it doesn't narrow the deficit. We're still looking at 6 and 7%, if not higher deficits on a go forward basis. So the total amount of debt outstanding is going to continue to grow. There are, you've seen articles out there of some concern about the debt level here in the United States, what that may mean. Is it eventually going to mean that we're going to have to pay more to borrow money? And I will say this: now that this is passed, we're going to see a big slug of new Treasury borrowing coming at us in a pretty short period of time. Our sense is they're going to do the majority of that on the short end of the Treasury curve, where the Fed controls interest rates and where demand remains pretty high. But Rick, there was a 30-year auction today, and it went fine. I mean, there's really no sign yet that there's any significant concern about our ability to fund our deficit. But I think anybody with a shred of fiscal sanity to them looks at this and just go, man, I just don't know how much longer this can continue. And so yeah, I'm concerned about the direction that we're going, but we're not in a crisis at the present time, and really don't feel like we're close to a crisis. But this is not sustainable over a longer period of time.
Anything else you'd like to mention, Steve? I appreciate your time today.
Yeah, Rick, look, this is one area where we're getting a little more certainty. Tax policies behind us now. We know what that looks like. The debt ceiling's been raised, but there's still plenty of question marks. Uncertainty still pretty high around tariff policies, where that's going to all end up. Around immigration, we've talked about that before. That's still, there's cyclical and secular parts to that remain some of a headwind out there. However, at its base, we still remain much more optimistic, particularly as we think longer term. What we're seeing from an economic growth standpoint is that we may go through this lull. In fact, we were negative 0.5% in the first quarter. We're going to see that rebound in the second quarter, maybe a little bit slower in the third and fourth. But as we start thinking about 2026 and 2027, and some of these investments that we can make from a corporate standpoint, there's an opportunity for us to see a significantly higher amount of growth as we move forward. That would be I'm optimistic as I say that. We're biased towards those policies that lead to growth. That's still possible, and we remain more optimistic than pessimistic.
Thank you so much, Steve.